Welcome to vTalkInsight, Risk Sentiment Daily for March 18, 2026. Global risk mood is pulled between an escalating Middle East energy shock and surprisingly resilient earnings and AI-driven growth. The result is caution rather than capitulation, as investors balance downside protection with selective risk-taking. Let's look at how that tension is shaping risk appetite across equities, credit, and currencies today. Across assets, the tone is cautiously defensive. The Middle East energy shock and Iran-Israel escalation still anchor macro risk, but the violent derating of a few sessions ago has softened into more two-way trading. Global equities are in their steepest monthly decline in over 3 years, yet the S&P 500 has stabilized, finishing the latest session slightly higher as volatility drifts lower. Positioning underscores that wariness. Fund surveys show cash balances jumping from around 3.5% to over 4%, the biggest rise since the pandemic. Growth optimism has collapsed while inflation fear surge, pushing stagflation to the forefront. Still, investors are largely staying invested, rotating toward liquid U.S. large caps, select technology, and energy winners, while trimming cyclicals and weaker balance sheets. Cross-asset moves tell a similar story. The dollar is firm as a safe haven and energy exporter, while currencies of European and Asian importers lag. Traditional diversifiers such as bonds and gold have given mixed protection, so portfolios are diversifying within risk assets instead. Overall, sentiment is cautious rather than panicked. Downside shocks are front of mind, but there is still appetite to take risk around specific themes, which we will now unpack. Middle East energy shock and oil spike remain the dominant macro risk. Conflict around Iran has escalated, with high-profile assassinations, intensifying drone and missile attacks on Gulf energy assets, and tight Iranian control of tanker traffic through the Strait of Hormuz. Brent now trades above $103, roughly 40% higher since the war began, and physical markets are signaling tighter supply than futures suggest. Key export hubs in the United Arab Emirates and Saudi Arabia have suffered shutdowns, while Iran is selectively allowing its own and aligned tankers through Hormuz. Reported passage has dropped to about a dozen Iran-linked vessels in 24 hours, leaving most Gulf exports blocked. Diesel in the United States has moved back to around $5 per gallon. Jet fuel is sharply higher, and European gas price projections for the next 2 years sit well above prior assumptions. This is a classic terms of trade shock for importers, weakening their currencies, supporting the dollar, and squeezing real incomes. It has driven global equities into their worst monthly drawdown in years, pushed cash balances higher, and accelerated flows into energy equities, even as other sectors lag. With efforts to assemble a robust naval coalition faltering, a rapid normalization of Hormuz traffic looks unlikely, keeping the energy risk premium elevated and leaving risk assets highly sensitive to further geopolitical headlines. Stagflation and central bank policy dilemma sit just behind the energy shock as a major headwind. The surge in oil, diesel, and gas prices is a classic supply shock. It pushes inflation higher while threatening to erode real growth. Fund surveys show inflation expectations jumping and global growth optimism collapsing, with stagflation moving from tail risk to central scenario. For the Federal Reserve, this backdrop is uncomfortable. Labor data do not show a sharp deterioration, so the committee can stay on hold, but higher energy costs mean inflation forecasts are likely to be revised up. Bond yields have already risen across the curve, and markets are pricing a somewhat more hawkish path, rolling back some of the easing expected later this year. European central banks face an even tougher trade-off. Imported energy shocks are lifting break-evens and squeezing real incomes, yet growth is weak and fiscal space limited. Policymakers are talking tough on inflation to keep expectations anchored, while trying to avoid hikes that could tip economies into recession. Until the balance shifts clearly toward easing, higher-for-longer policy rates and persistent inflation risks remain a drag on duration-sensitive assets and on equity valuation multiples. Private credit and broader credit stress are another important, slower-moving risk. Research from major dealers flags the potential for private credit default rates to climb toward 8%, near pandemic peaks, driven by high leverage and looming maturity walls, particularly in software-related exposures. In leveraged loans, headline performance has been only mildly negative, but software loans have sold off more sharply, underscoring sector-specific strain. Retail-oriented, semi-liquid private credit vehicles are already feeling pressure. Investor redemptions are forcing asset sales near par and exposing liquidity mismatches between frequent exit windows and multi-year underlying loans. Institutional allocators are responding by stepping back from these hybrid structures and favoring traditional closed-end funds, which lock in capital and can ride out volatility. The systemic risk lies less in immediate bank contagion and more in opacity and leverage. Private markets allow lenders to extend credit creatively to marginal borrowers, and valuation marks can lag reality, raising the chance that problems emerge later and abruptly. For public markets, this argues for a more discriminating risk premium in high yield and loans, even as investment-grade credit and well-capitalized banks appear comparatively resilient for now. On the bullish side, AI investment boom and tech earnings are a powerful counterweight to macro risk. Hyperscaler capital expenditure is projected to jump to around $700 billion this year from roughly $400 billion last year, driven largely by AI infrastructure. NVIDIA has outlined more than $1 trillion of high-confidence order visibility for its latest platforms through 2027, reinforcing expectations for sustained data center demand. Revenues further down the stack are also surging. Leading AI model providers have seen annualized sales climb into the tens of billions, while venture capital is funneling significant funding into GPU cloud and infrastructure platforms. U.S. non-farm productivity is running close to 3% year-on-year, above trend, with expectations that AI-driven automation will push efficiency gains higher over time. This investment wave is global. A large share of hyperscaler and NVIDIA-related capex is expected to flow into Asian supply chains spanning chips, memory, and robotics, while defense technology firms focused on AI and unmanned systems are seeing rising government urgency. There are risks of overinvestment and hardware inflation, but the breadth of AI demand and the strong balance sheets of leading platforms continue to underpin a constructive medium-term earnings narrative for the technology complex. Resilient U.S. earnings and equity outlook form the second major bullish pillar. Corporate America continues to deliver strong results, with wide profit margins providing a buffer against higher energy and wage costs. Analysts expect double-digit earnings growth this year, and historically, when that has happened, U.S. equities have advanced in most cases with mid-teens average gains. Recent company-level data back that up. Major airlines such as Delta and American are reporting record single-day sales and robust premium travel demand, even as jet fuel costs surge. More broadly, strong earnings growth and record-high profit margins across the S&P 500, including improving trends among small caps, support a constructive view on U.S. equities relative to international peers. At the same time, valuations have derated from extremes, and credit markets remain functional, with stress largely confined to high-yield technology. De-risking by systematic funds, hedge funds, and retail investors has reset positioning and flushed out weaker hands. That leaves scope for a meaningful rebound if positive catalysts emerge, whether from geopolitical de-escalation, stabilizing energy prices, or continued earnings surprises, even though recession risk is not yet fully priced. Central bank pause and rate cut option round out the bullish side. Despite the energy-driven inflation shock, the Federal Reserve is widely expected to hold rates steady at the upcoming meeting. Officials are likely to mark inflation forecasts higher and perhaps nudge unemployment projections up, but current guidance points to keeping the door open to cuts later in the year rather than signaling a renewed hiking cycle. Other central banks are adopting a similar stance. In Europe, policymakers are talking tough on inflation to keep expectations anchored, yet acknowledge that policy is already restrictive and growth fragile. In the United Kingdom, break-even inflation has risen, but the Bank of England is still seen staying on hold. Across developed markets, the bias is toward a prolonged pause, with central banks prioritizing stability and avoiding policy errors over aggressive moves. This approach has two implications for risk assets. In the near term, a stable policy rate backdrop can help cap volatility by reducing the risk of surprise hikes. Further out, if geopolitics and energy start to weigh more heavily on growth and employment, the narrative could pivot toward earlier or larger cuts, as suggested by increased focus on easing in worst-case scenarios. Emerging market local bonds, where inflation has already rolled over and policy rates are high, illustrate how that easing option can still underpin risk appetite even after geopolitics-driven drawdowns. To wrap up, risk sentiment is cautiously defensive. An acute Middle East energy shock, rising stagflation risk, and simmering private credit stress are keeping investors on guard and supporting the dollar. Offsetting that, a powerful AI-driven capex cycle, resilient U.S. earnings, and central banks inclined to pause rather than hike are preventing a full risk-off capitulation. Watch Hormuz traffic, oil and diesel prices, private credit default trends, and the next round of central bank projections as key signposts for whether this fragile balance holds or tilts toward renewed de-risking. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.